there's two main things you need in a plan. You need a starting point, which is now, let's say, and you need ultimately a finish, an end point. Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. I'm here each and every week to help educate and inform on all things financial, from historical context to current context, because after all, your money matters. Happy New Year. Let's just start off with that. And happy 2023, everyone. I hope you all had a wonderful holiday season. You know, with all the New Year's resolutions many of us are making right now, I know I am, I want to sort of piggyback on that and start the new year discussing some of the changes, and most notably, the changes that come up or that we think about, or some of the limits, if you will, on the IRA and the 401k contribution limits for 2023 and how those are changing. We're also going to go into some other things as well. But before we do, I hope you know what to do by now. If you've been watching me all last year, smash that subscribe button and hit the notification bell so you don't miss a single episode. All right, let's get into it. You've heard me say many times, retirement doesn't need to mean that you are 55, 60, or 65. It just means to be living financially free without having to work. Essentially, what I look at as your money context is having your money work for you instead of you working for your money. So whether that's in your 40s or even your 30s, either way, the retirement or saving for that period of time, it can seem like a daunting task. But for any clients listening right now at One Capital, we talk about utilizing 401k assets, IRA assets, anything that's tax deferred, even Roth, like retirement savings vehicles. Those are all the best ways and most tax-friendly ways to build a nest egg. So plain and simple, you should start saving on a 401k account as soon as you can. If your employer offers that because the IRS limits how much you can contribute each year, do it. Now, for this year, 2023, these limits went up from last year. So we're going to start out right out of the gate this year talking about the increase in limits. Workers, for those of you watching right now who are younger than age 50, can contribute a maximum of $22,500 to your 401k in 2023. That's up from $20,500 last year. And that's the largest increase we've seen in almost 30 years. Inflation, obviously, is the main part of that. Now, if you're age 50 or older listening, you can also add a catch-up of $7,500 per year, which basically brings your total 401k contributions for 2023 to $30,000. So contributions to a 401k, they're generally due by the end of the year, end of the calendar year. I talk with a lot of my CPA professionals that we work with for our clients. It's called by 12/31. So you want to make sure any contributions you're looking at doing, you want to have in by December 31st. So we're in the first week of January, friends. So let's get this thing going now. You got 24 or 26 pay periods in this year, depending on if you're biweekly or semi-monthly. You have that time to figure out how much you want to contribute. And as I always say, discipline and discernment. The number one reason why 401k assets or retirement assets are the largest part of retirees' net worth isn't because of the next best thing since sliced bread. I mean, they're great, and you find a good manager, you can get good investments. It's because it's the one thing in a household typically that is consistently over the years invested into. Not only just consistently, every 2 weeks, every pay period. So you got to think about that. So utilize it now. But it's important to also look ahead. As we all know in life, rather than look behind. I've always shared this analogy. You want to look at the windshield. When you're driving, you want to look at the windshield, not the rearview mirror, right? And that's what we're going to be focusing on here today. And one of the questions I think that comes up around savings and retirement and any items around that, the big question of how much you should save for in retirement. Now, I start off this year with having this conversation because it's probably one of the top 3 questions I get asked as a financial advisor. So I want to talk about that as it hits your New Year's resolution list. Okay, so many of you can Google this. You can read a white paper. You can talk to your friends, your colleagues, family members. But there's a consortium of people out there, if you will, of experts that recommend that workers or people who are employed save at least 15% of their income for retirement, which is, by the way, includes any employer match. In 401k plans, you might have a match. That includes that. So let me give you an example. For instance, if your employer contributes 3% as a match in your 401k plan, then you would need to save an additional 12% to get what the experts are recommending of 15% of your income. Stopping there for a second, that answers the first big question of how much I should be contributing to retirement, right? That says, okay, and then we get into other questions around traditional or Roth, which those tend to be a little bit more specific. That's where you want to hire counsel and hire an advisor to kind of help you through that. Now, if you aren't saving that much, by the way, right now, my one recommendation is to put on your heart, pray on it, think on it, put it on your New Year's resolutions, but increase your contributions until you reach that goal. It doesn't have to be right away, but it's a good start. So start increasing it. And you'll notice if you start increasing it by like $50 a month, $100 a month, you won't really notice it. And to the point you do notice it is probably when you're probably maxed out based on that current year's income. And one of the things I talk heavily about when it comes to planning, and especially for those in our categories of clients that haven't put together a plan, a financial plan, all of a sudden they get this almost coffee buzz rush, right? We build this plan like, okay, Brad, it looks great. We're gonna do this. I'm first week of January. I got my New Year's resolutions. I'm ready to go. And I tell them, remember, as I just said, it's okay to have a few years to build this out. We don't want that instant overnight situation. We wanna let this bake. We also wanna make sure that we don't cut our nose to spite our face, right? It's okay to have that gradually increase. It's just the mindset, really what I'm talking about, of having that goal there to actually do so. As I share often, it's easy in life to get motivated. It's harder to stay disciplined, right? Same thing with your money. Now's the time to set that New Year's resolution, to have a goal in mind. That's where a plan comes in. You hear me harp on this all the time, but a plan, actually, there's two main things you need in a plan. You need a starting point, which is now, let's say, and you need ultimately a finish, an end point. So the point of the matter is, have a goal in mind. If you don't know what those are, that's where an advisor comes in. They help with what we call here at One Capital our discovery meeting. We get to know you. We talk asking not only just the quantitative, like numbers questions, but also the qualitative questions. Now, I want to go back to something real quickly and dissect the 15% a little bit more. Now, those maximum limits may not be that hard based on your overall income. And what's more important is, in that regard, is your disposable income. But for those that see those limits as really lofty or high, it's really important to make sure that we focus on the more granular details, which is how much per paycheck you should be saving. But that all has to do with what I talk about quite often here. As those who are frequent listeners know, or watching the show, we talk about distribution rate, ultimately in retirement. And I say this differently sometimes. It's ultimately a percentage of your spending relative to your liquid assets. So something we do here at One Capital is when we build our Black Book, which is our proprietary wealth forecast for our client, our financial plan, if you will, we focus on accumulating your assets relative to the goals and objectives you have in retirement. So I'm not going to share my financial plan with someone else, not for secrecy, just because my goals and objectives my wife and I have wouldn't necessarily be theirs. Likewise, don't compare or match yourself to Elon Musk or Bezos or Jeff Bezos. Like, why? Their plans are completely different than yours, right? So you want to make sure you're on your own track. And so you want to think, so what does that mean, Brad? Well, if you're sitting here and you're in your 30s and your 40s and you want to forecast that out 20 or 30 years using conservative assumptions, meaning higher inflation numbers, lower rate of returns, under promising, over delivering, essentially, we want to make sure this is all what we call needs-based, not wants-based. Those are two very important words when it comes to financial planning: need and want. We want to focus on the needs of what you need to bring in to keep the lights on for yourself and your family. And we focus that as relative to your investments and your savings. And that gets, in my opinion, to a more specific number rather than some broad stroke of 15%. That's, I think, more generalized based on a bunch of experts across the country. And if you Google this, it's probably the top 3 articles you'll see. That's where I got that from. Like, okay, I understand where they're coming from. It's a good starting point, but make sure it works for you. By the way, one thing I will agree with them on, I do like that it's percentage based, not dollar amount based. That's something we talk about heavily, because having a percentage based allows you to fluctuate with your income on certain things. It also says if you're making $50,000 a year or $200,000 a year, the percentage is relative to the income, not necessarily a dollar amount. Makes a big difference. So focus on your number, okay? That's the biggest thing I want to share here. Tailor your investments the same way you would tailor your planning. Believe it or not, most people don't do that. They want to focus on, I have this stock or this investment. But the reality is, if you're going to tailor that, you should also be tailoring your goals and objectives to fit into that narrative of that investment. And you find out very clearly if that investment is actually, in fact, very good or not so good for you. You want to do all that relative to your planning and focus on what you need, not what your neighbor needs. One thing I want to share this year, as I realized through last year, and as always in nearly 2 decades in this business, is we want to be careful of the comparison situation, right? We want to be careful that we don't just, granularize, okay, what my neighbor John is doing is what I should be doing. Like maybe not. That's where advisor comes in. Like specific advice matters. But what I'm also trying to say is also to empower each of you to get a little bit further into it. Is 15% enough? Maybe it's too much. In fact, odds are it might be higher than what you actually need to save based on other assets or other assets you might have in your overall planning, whether that's real estate assets, maybe Social Security that people aren't factoring in, pensions potentially. If you're lucky enough nowadays to have a pension, all those need to be considered when we're looking at the question, again, back to the original question of how much you should save for retirement. Because I think as we're sitting down and we're going through our New Year's resolutions, that question is going to come up. It's going to come up around, do I have enough money? Am I in the right investments? How much should I be investing or putting in there? The easy answer, ladies and gentlemen, is to max out. Look, I'm just gonna be honest with you. If you can max out your cash flow, do it. It's just simple math. I mean, if you can max out, you do the math on it, you go 10, 20, 30-year career, whatever it might be, do simple math without any rate of return, and you're gonna have a pretty sizable number. Now you need to compare that number to future forecasts of inflation and then what you need to be pulling from that, which is where the distribution rate comes in. And that's where you have a solid plan. Now, I understand that every enrollment meeting I've ever done for a company that we put a 401k plan in for, this comes up with questions, which is why I wanted to touch on it as part of our New Year's, New You financial plan conversation. Every client that we build a plan for here at One Capital, this question comes up, whether they ask it or we bring it up because it's an important one. But I want to say very clearly here is there is not one right answer. It has to be tailored. It has to be custom. It has to be made to your planning, your money, your wants, your goals, your objectives, because they'll be different than the next person. You know that, I know that. So we want to make sure that your planning follows suit. And heading into 2023, that we're here, I also want to touch on a few other things other than the contribution limits that have changed, but also focusing on taxes. So I'm going to switch gears for a second. Taxes are a really important factor to consider into the next year. With what money you're perceiving, we're seeing a higher income tax brackets potentially in a couple of years. It's really important to make sure you have a coordinated team. That's what I want to share. Coordinated and integrated. Advisor, tax preparer. They need to be communicating. Ask yourself right now, A, do I have an advisor that I like and I trust? That's number one. B, two, is that advisor that I like and I trust communicating with the person I'm doing my taxes with? That really is important. And as you get older, as your taxes get more complicated, your retirement planning gets more complicated, you ultimately get into retirement, you're gonna want that team. You're gonna want that communication, if you will. And your tax preparer in particular should know, and I call it the bracket game. We wanna make sure in this year and every year, we maximize the most out of the lowest bracket. So we wanna be at the high end of the lowest bracket. And it matters when you have a marginal tax bracket system, which we do. So although taxes may be going up, I agree with that. I don't know when, how, we'll find that in the future, but it is marginal. So you can still be strategic when it comes to tax planning, because you might be thinking, why is a financial advisor or an investment manager focusing so much on taxes? I'll tell you why. Taxes have a lot to do with the efficiency and the effectiveness of your income and your overall investments, especially in retirement. And we are starting the new year here in January, but we are also in tax season, my friends. If you have not already received it, you will in the next couple of weeks. You'll receive your income reports from last year. You're gonna be sending it over to your CPA. You wanna make sure that you're having dialogue with your advisor and your CPA around that. Not just retroactively, like reactively so much, but also proactively. Start this year to say, okay, what can I do this year that's gonna set myself up for next year and the year after that, and so on. And you heard me say this week in and week out, retirement is largely about income. Again, retirement means being financially free. Again, that does not revolve around an age. It's not a NRA, national retirement age like from the government. It's when you become financially free, receiving income from the assets that you saved or have enough saved to distribute your assets in your 30s and 40s or at your 60s or 70s. Whatever it is for you, we want to make sure we tailor that plan so it fits you. Now, you may be on the traditional side where you have worked for 30, 35 years in a job and now you're in your 60s and you're traditionally retired. Either way, it doesn't matter. Focusing on taxes has a lot to do with this. Again, whether in your 30s or 40s. And I share this openly when it comes to asset classes or types of assets. There's really two main forms, right? There is the taxable and the non-taxable, right? The taxable assets are the ones that you've already paid taxes on. Right? Those are your trust accounts, your joint accounts, your individual brokerage accounts, maybe a Roth if you're over the age of 59 and a half and have had it for 5 years. Those are the two requirements, right? And then there's the non-taxable accounts. That's the IRA, the 401k, 403b, 457 plan, whatever it might be based on your job type. And so you want to make sure that you have a happy marriage between those two. And ultimately, how you start distributing. One of the questions I get a lot, and if you're thinking about this year right now, maybe you're heading into retirement or thinking more about this is, do I want to have all my eggs in a tax-deferred asset, the non-taxable, or do I want to have a mixture of both, of taxable and non-taxable? I'm of the opinion you should have both. The more buckets, if you will, you have, the more creative tax planning we can do, right? For example, I have a client recently that a couple weeks ago, we were meeting early December about distribution planning for 2023. And they needed about $30,000 a year on top of their pension and Social Security they're receiving. And so we went through it and we looked through their assets, and they have about 50-50 split. So about 50% of their assets are in taxable accounts, meaning again, joint accounts, cash, individual accounts, and they also have a Roth. And the other 50% is in 401k assets. So we got on the phone with their CPA a week later, before the new year, and he basically put their taxes together. I was on the call with him and said it well. And we said, okay, we need about $30,000. We took about $20,000 from the cash side and $10,000 from the non-taxable side. Why? It wasn't just because we made those numbers up. We realized in their tax bracket and their income, they can take an additional $10,000 that year, last year, 2022, and still be in the same tax bracket for that year. So we maximized the highest of the lowest tax bracket. And we also got them the distribution they need for the entire year of 2023. So now their investments don't have to get pinged every month for distributions. You can see very clearly in that example of how integration matters between an advisor, an investment manager, and your tax preparer or your CPA. So taxes, as I've been mentioning, it should be on your list to kind of focus on obviously for this season, but taxes in 2023 as part of your New Year's resolutions have a lot to do with your planning and your investments. And that brings up the last thing I want to talk about today on this week's show around traditional 401ks versus Roth, or traditional IRAs versus Roth. Now, a 401k works best for someone who anticipates being in a lower income tax bracket at retirement than they're in right now. Now, conversely, Roth is the opposite. They're assuming that taxes are going to be higher when they're in their retirement years, their true retirement years, maybe 60s and 70s. Therefore, they'd rather pay taxes now and contribute to Roth on a post-tax basis now to receive that income later tax-free. Because again, they perceive they're going to be in a higher tax bracket than they are now. For example, on a traditional 401k, let's say someone is currently in the 32% or 35% tax bracket, but they're able to retire maybe in the 24% tax bracket. Well, the numbers would shake out that say, okay, I'd rather defer at a higher tax bracket and pull at a lower tax bracket. That just makes sense. There's one big thing though that needs to be brought up here is we don't know what our retirement years will hold. We can assume, and I think we all can agree, you can get a bunch of economists together, a bunch of financial gurus together, tax gurus, and a bunch of just general people together. And I think all of us line up and say and think pragmatically and logically thinking we're going to be in a higher tax environment than we are right now, let's say in the next 10 or 20 years. And I think a large part of people will think that. The answer is yes, but we don't know. So employers have been increasing tax diversification in their retirement plans by adding Roth 401ks for those that actually think they're going to be in a higher tax bracket in retirement. And these accounts combine features of Roth IRAs and 401ks. So contributions that go into a Roth 401k after you pay taxes on the money, as I mentioned, you're contributing with post-tax dollars. You can withdraw contributions and earnings tax and penalty free if you're at least age 59 and a half and have owned the account for 5 years or more. Basically the same rules as a Roth IRA. They'll also be required to take minimum distributions from a Roth 401k once you turn 72, which is different because you might be able to avoid RMDs if you can move the money from a Roth 401k to a Roth IRA, because a Roth IRA is not subject to RMDs. And that gets a little in the more granular details. That's where I would seek counsel and advice, as I share each week with taxes and with investments. Find that advisor to talk about those things, because you want to make sure that you know which account type is right for you and which one you should be, what percentages of each you should be going into. Now, so far on the Make Your Money Matter show today, we've talked about two main things that I think really should be on the New Year's resolution list, just all throughout the year, frankly. So I want to hit on that as we start the year. And that's contribution limit changes, because those are factual. They've changed this year, as well as how taxes, because we are in tax season technically between January and let's say April 15th, it's a good time for us to think about taxes. So I want to touch on those too. But I also want to kind of put on your mind as you're thinking through getting your diet in order, thinking through, getting your workouts in differently, whatever it might be, put finances on your list. And the way I want to look at that is this way. Take a look at your budget, take a look at your cash flow. That's step number one. Find in that cash flow where you can move some things around. What do you really need? Are there subscriptions that you don't need anymore or don't use as much? Now's the time to do a little house cleaning. I know they call it spring cleaning. Let's do it in January. Let's get ready for spring. If you see any savings there, Add that to your 401k contributions. Add that to your investments. It's a great way. If you have debt, itemize the debt. Figure out what you have, where you have it, what the amounts are in terms of the interest rates and the monthly payment. If you have any savings on any of those items from step number 1, pay the debt down first, then do your investments. So that's step 1, 2, and 3. And after that, stay the course. So this year, I think what I'm going to be sharing this theme for all of 2023 is discipline. I'm going to harp on that word. I talk about it all the time. I talk about the 2 Ds, right? Discipline and discernment. Now's the time to stay disciplined. It's very easy for us to get, what I call the caffeine high, as I said earlier, right? You get the caffeine high. It's easy to get motivated, much harder to stay disciplined. So we're going to focus on that. So take a look at what you have actually going out every month. Do some spring cleaning in January. Let's start there, right? If you have debt, maybe add to the monthly payments to pay that debt off sooner. If you don't have debt, put that to your investments. Look at your 401k contributions. Find out if it makes sense for you to maybe max that out. If you have more on top of that, that's when you start investing after tax as well, meaning in a joint account or a brokerage account. And again, after that, figure out how to stay the course. And if that's finding someone to help you with that, stay on the course, which is a lot of value of an advisor, seek that counsel. You can reach out to us. Now's the time to get your plans in order, and don't do it alone. Now's not the time to kind of, go John Wayne on your assets, Try to figure out how you want to do it with someone, with that co-pilot, and make sure you can kind of move down the road together and know where you're going with your money. The one thing I'll say, and I'm putting this from my wife and I too, is what are we doing with our money? Find purpose in your why. Find purpose in, okay, last year was crazy. We had a volatile year, high inflation, a lot of supply chain issues. For those of you watching and listening to me last year, you've heard me say this constantly. This year, we're going to pick up on that because obviously it's still relevant. We're still having it. But the reality is I want to talk about discipline and how to see through the fog. Because ultimately, again, back to my point of retirement, we use this word retirement like you have to be 65 years old. And the reality is I have clients all the time retiring in their 40s. I have clients retiring in their 80s. The age is really irrelevant. Again, to me, it's twofold. Financially speaking, it's when your money works for you and you're not working for your money, right? And then secondarily, I think just life-wise, it's when you are free enough with your time and you saved enough within your own lifestyle limits to not need a paycheck and you can work on with the assets that you have. And combining those two matter a lot. And so I think now on your New Year's resolution list, keep that in mind as you kind of set the course, understand the contribution limits, know that we're in tax season. It's a great time to make sure that your advisor is coordinating with your CPA and vice versa. That's important. And then thirdly, take those lists I mentioned. Understand what's in your budget, pay down some debt. If you can move some budget around and pay that down faster. If you don't have debt, go to step 3 right away. Look at adding to your contribution limits, whether it's your 401k or after-tax assets, and then stay the course. Don't let things around you get blipped up. You know what I mean? I've said this before. I like this sharing. I want to start this new year off saying this. Remember this. It's not the water around the boat that sinks the ship. It's the water that gets in. Don't let the noise get in. If you got a solid plan and you got a solid partner that you're working with, I'm telling you right now, that noise is going to get a lot harder to get in because you're staying your course. You're focused. You get in that car and you know where you're going. Don't get in the proverbial car with your investments or your money, right? And just wander around aimlessly. Probably not the best bet. So as we sum up this week, talking about contribution limits, taxes, like I mentioned, heading into the new year, we talked about some retirement savings tips. The first one I want to bring up to find counsel, as I said this before, make sure you work with a partner. I know I preach on this every week, but it's important. I think it's better than ever before. Starting the new year, find that person that you can work with. In fact, last week, we got invited to a holiday party, and it was interesting. We started talking about some of the dinner conversations around finances. This was a New Year's party, and the world and the economy and things like this. And one of the ladies there, my neighbor, was actually talking about how she just retired. She's early in her 70s. She has a couple 401ks. She was a doctor, and she called Fidelity, a very large custodian, trying to merge them all into an IRA. And she just kept getting this script from this young guy that was basically trying to upsell her on some things through their custodian. And she was asking me, and I sadly had to say, that's not uncommon. So one of the things that she was trying to avoid was RMDs and understanding the nuances between RMDs and a 401k and an IRA. And I remember saying to her the other night, you summed up a lot of the advantages and values of an advisor. She was looking for that. And so when we talk about an advisor, find that advisor. It's not just for a rate of return. Advisors add value by basically avoiding landmines, those potholes in the road that you don't know are there. That's really where the advisor comes in, let alone setting the course for your retirement, helping keep discipline, putting a good portfolio around you. So as you're looking at the new year, find that counsel. I really believe in that. Find someone that can help you with that, to help all the goals that you might have with your money. Okay, it's that time of the show where we have the question of the day. If you have a question or topic you'd like me to address here on the show, you can leave a comment or a question in the comment section. Or if it's something you want to talk more one-on-one, just go to the About page on this channel and send us an email. Again, we'll always keep the questions I read here anonymous. You never have to worry about your name being shared, but we'd love to hear from you. This week's question, I'm reading it here for the first time. My producer, Brian, kind of sent it in. It says, Brad, what's on your New Year's resolution list? That's a good question. Well, my wife and I were kind of talking about it last week for New Year's. For us, it's diet. You know, I gotta be honest with you. For us, it's like many of you, it's kind of focusing on, and it has to do with money actually. So a lot of it was budget related. You know, we were both kind of talking through the holidays that a lot of our budget is going towards, we have 2 young kids, going towards eating out and food. So we wanted to kind of focus on a twofold thing, eating healthier and also saving money along the way. So that's on our list. You know, I think everyone starts off with the good intentions. I preach this often about discipline. Usually in my history, you know, if we set the course and have an accountability partner, in this case, my wife, for many of you looking to get your finances in order, that accountability partner is an advisor. We tend to do well. We get the consistency of it. So, and again, like all things in life, I want to make sure I have a happy balance. So it's not like we're going to go cold turkey, not going to, you know, McDonald's to get Happy Meals for the kids. But we want to have that good position. So that's on our list. That's a great question. So anyways, happy to share it. Again, if you have a question or comment you'd like me to read here, leave it in the comment section, or again, you can email us in the About page on this channel. Before we go, if you found anything helpful today and want to learn more, you can visit our website at onecapital.com. You can scan the QR code on the screen with your smartphone. It'll also get you there. You can also call or text us. We want to help. Listen, there's no pressure. We don't treat people like a number. We value our relationships. It's the lifeblood of what we do. So click, call, or text us today. If you're not following us on social media, you should be. We're sharing great information on all of our social media platforms. And as I often say, if you enjoy the show, share with someone you like. And I guess if you don't like the show, share with someone you don't like. But until next time, always remember, make your money matter.